The Federal Reserve just held interest rates steady at the 3.5 to 3.75% mark. That part was expected, but what actually changed was the tone underneath the decision. On paper, not much has moved. The Fed is still signaling one rate cut in 26 and another in 27, but when you look a bit deeper, conviction is fading. 7 Fed officials now expect no cuts at all this year. That's up from the last meeting, and that matters, because that tells you the Fed is becoming less confident that inflation is under control. Let's look at the backdrop. Inflation is still running around 2.7% on the PCE, which is above the Fed's 2% target, and importantly, does not fully reflect the recent move higher in oil due to the war. With the Iran conflict, pressure on the Strait of Hormuz, energy is now back in the conversation. And at the same time, the economy is holding up. Growth is sitting around 2.4%, and unemployment is still relatively stable at 4.4%. So the Fed is stuck in the middle. And this is the key point. They're not tightening, but they're also not ready to ease. They're waiting. Markets have already adjusted to this. We have gone from expecting 2 cuts this year to now pricing in 1, and some people think we won't actually get a cut at all. So the Fed is not leading here. It's just confirming what markets have already figured out. There is also a bigger dynamic at play. With Powell nearing the end of his term and the new chair likely coming in, the dot plot doesn't matter as much as it used to. Forward guidance only works if leadership behind it is stable. Right now, that is also uncertain. So where does that leave us? Inflation is still too high, growth is still holding up, and the Fed is firmly on hold until the data gives them a clearer path. So if anything, this was just a reminder. The path to rate cuts is not guaranteed, and the market may need to stay patient for just a little while longer.